Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and joined by the co-host, the one, the only, Andrew.
Billy, this isn't just another episode of the 360 Money Matters podcast. This is the episode of the 360 Monies podcast, isn't it?
We're very excited to announce that it's only been a very, very short time, but this is episode number 50. So yeah, celebration time.
Yeah, party. We're having a bit of a big bash. Everyone's coming in and we're celebrating.
That's it. And hopefully we've got a bit of a special episode to kick it off because it's not about us, it's about our listeners. So we'll celebrate that milestone and get into the episode. But Andrew, what are we talking to everyone about today?
Yeah, so today, sort of a bit of an anniversary edition. So we're talking all about the process or the financial planning process. So what we go through with our clients, good high level summary around, all of the things that we look at and what clients and listeners should be looking at when they're developing their own financial plan, and a bit of a process on how to get there, how to structure it, and, what you should be looking at.
Yeah, so this will be a really succinct summary of kind of all of the stuff that we've spoken about, just high level kind of refresher, and hopefully brings it all together for everybody in terms of what we do with clients when we're actually going through that process. So yeah, I'm excited. And
we did a 6-part series on all of this, and now we're trying to cram it into one episode. So we're going to have to talk really, really fast.
Well, I think that was episode 1, wasn't it? That was the original one. So we've come full circle.
Exactly right. Hence the practice name, 360 Financial. That's full circle.
Andrew, kick us off. What's the first one?
Yes, first, simple, easy, or for most people it's easy unless you've got things flying around everywhere, but getting an idea of your current position. You're looking at a financial plan, you're looking at, doing some things in terms of wealth creation, in terms of, some retirement planning, some blue sky thinking, but it all kind of means nothing if you don't know what your current position is. So really getting a solid understanding of all of your assets, all of your liabilities, make sure that you know where everything is, where it's positioned, and get that sort of starting point. So it's the first point on the graph, it's the beginning point, but really getting a good understanding of where your assets and liabilities are is always the first point in call in any financial plan.
And just on that, look, it doesn't need to be too complicated. Literally pen, paper, or an Excel document. That way it just seems easy enough to edit it and sum things up in bits and pieces. But whatever works for you as an individual or you as a family, then that's what you should do. You don't want to overcook this. You don't need to get fancy. We don't necessarily lean into needing to use particular softwares to do it. I think it just adds a layer of complexity. So short, sharp, simple, whatever works for you. It shouldn't take too long to do anyway, right?
Yeah, and especially, what we're talking about here is getting started on your financial plan. So if you've already got a plan in place, if you've already got a strategy in place, and you're looking at drawing equity out of properties, you're looking at doing some more complex things, then obviously you're going to need to do valuations on properties. You're going to need to go into a little bit more detail as and when you get further along. But in the initial stages, what you're looking at is really just an estimate in terms of what your asset values ultimately are. So, a simple, and for most people, the one that's most complex is just properties. So a simple, online, how much is my property worth? Bit of a Google search is good enough for this initial stage.
And all we're trying to do literally at this stage is just basically get a baseline. So a line in the sand. That's it, right? So it doesn't need to be overly complicated. Second part, what are we looking at?
Yeah, second one is really determining, how much you're saving, what your income and expenses ultimately are. And that is ultimately going to determine your cash flow position as well. So how much money you've got to allocate towards savings, towards investments, towards rainy day funds, towards all of that stuff. But really what we're trying to determine is what's your current savings capacity and what's your ability to invest and utilize those savings. So really budget is sort of the one word throwaway in all of that.
So in real simple terms, we're looking at the difference between what you earn and what you spend. Basically the surplus. Obviously, the bigger that number, the better off we are because it gives us more options in terms of what we can do down the track. But kind of contradicting my previous statement before, you're right, budget, need to do this. In this instance, I actually find that using something like a software program tends to work. There's heaps of free things online. I know the government's got something through their websites as well too, being Money Smart. That's the government resources around that. They've got some good calculators in there doing it. And we've spoken about this a lot of times on the podcast, but I guess there's a difference between an aspirational budget versus an actual budget. So this, when you do this exercise, it shouldn't be looking forward and saying, hey, this is what I want my budget to look like. You should actually look back at your actual expenses and build it there. So this one takes a little bit of time to get right. You can tweak it down the track and, hopefully you can identify if there are some things that don't look right. You're spending more on certain things. Your budget should help you identify that and put some discipline around spending in those particular categories. But yes, the difference between an aspirational budget versus an actual budget, we've seen kind of every flavor of the rainbow when it comes to this. And you look at it and someone's saying that they're saving, tens of thousands of dollars a year. And then you ask them from an assets position, how much have you got in savings? And they've got, a really small amount. So that just doesn't compute from a mathematical perspective. But yeah, that's probably the one thing on the budget I've got to say.
And a little bit of a tip and a hint in this, I'd actually go the other end. I mean, when you're sort of trying to establish a baseline, what you want to show is, or what you want to do to feel good about what you're doing and the efforts that you're making is look at where you were versus where you are. So if you're doing where you were and you're doing a, current position in terms of budget, overstate your expenses, because once you're doing your aspirational budget about, where you should be, you're making an even bigger difference and you're painting a picture of, even more in terms of where you've gone. So yeah, if anything, you really want to make this realistic around where your expenses currently are, not where you want them to be.
Yeah, absolutely.
Which is kind of the perfect segue and the perfect way into the next point, isn't it, Bills?
Yeah, so next one is really off the back of the budget, being able to then look at the things that you've done. And, we all know about trying to increase income, and we've spoken about side hustles and things like that. So that's a given. Obviously, you try and increase your income as much as you can, because that will increase your surplus. But the thing that tends to have, I think, a bigger impact is once you've identified your expenses in your budget, you then look at them and figure out, okay, am I overspending? Are there things that I can adjust and improve? And really the determination or the objective with this is to determine whether you can increase the surplus that you've got, if you've got a surplus, or if you can try and create a surplus. That's really the intent of this, because like I said right at the start, if you can maximize that position, that really gives you as much of an opportunity to be able to really achieve the overall objective of all of this, which is wealth creation. So the bigger the surplus, the bigger the opportunity that you've got. And doing that, there's, certain websites that you can look up around benchmarking. You can look at, if you've got some data, you can look at what you're spending on an expense, say this year versus previous years. And if it looks like it's increased too much, and this is a little bit more challenging in an inflationary environment, but that should be easy pickings to identify it and say, hey, my X expense has gone up by 20%. Maybe I should start tackling that one and see if I can try and get that down. And then from there, Andrew, we move into the bucketing strategy.
Yeah, exactly. So easiest way and what we find is probably the best way in order to manage those expenses and really maximize that surplus income that you've got is creating a bucketing strategy with the income that's coming into the household. So really, straightforward, simple in terms of what you're doing from a bucketing strategy. There's a few different accounts and each person is going to be different and each person is going to have, different buckets depending on what they're trying to achieve. But if you're looking for sort of a standardized template, money goes into a bank account. It's a bank account that receives all of your income, but you're not actually paying your expenses out of it. So out of the amount of money that's coming into the household or the main bucket, you're then distributing money to, one for your fixed expenses, your direct debit expenses, one for your point of sale expenses. So one for, going to grocery store, petrol station, all of the expenses that you're paying on a frequent basis that you can't direct debit out. Another bucket that's going towards, having a savings buffer and a rainy day fund. Another bucket that's going towards investments that's then been spread off the back end of there. Another bucket that's going towards, potentially holiday savings. So really you can take this as far and wide or as, small and simple as you like, but creating a strategy where you don't need to think every single week, month, fortnight, however frequently you get paid. Money's come into my account. Yeah, I should put money towards investments, but yeah, I do have, that TV that I want to buy. It's just money goes into every single bucket. It's direct debited every single time money comes into your bank account, and you don't need to think about where it goes. It just automatically goes to where it needs to. And once you've gotten to that, all right, holiday savings account is at 10 grand. Great. let's book a holiday and let's recharge the batteries and let's, spend the money on that. You don't need to factor things in because you've already pre-thought it out. You already know where it's going and you're not overspending.
Yeah, really what this does is puts everything on autopilot. That's the sort of the first thought I've got on there. The second thought is a concept that we've shared before, but every dollar has a job. So you're allocating it based on predetermined amounts. And as long as you can keep discipline around your spending, all of that system should work nice and easy. And the third thing is, Andrew, I'm really itching for a whiteboard here because demonstrating that over audio versus being able to draw it is completely different, but hopefully you did it justice. But yeah, it's definitely the way to go, and you want to try and get it on autopilot as best as you can, because then you don't have to think about it and it becomes something that you don't need to pay attention to, but in a positive sense, because it just happens automatically and it's doing what it's meant to do if you're doing all of the right behaviors. And I think the thing to point out with all of this is the bucketing strategy and getting this system right only works really with two things. First thing is that the numbers that you've pumped into the budget actually accurate, which goes back to an aspirational budget versus an actual budget. And the second thing is just having discipline, that if you do have a discretionary bucket where you do go out and spend money on, the discretionary things, you go out for dinner or whatever it may be, if you deplete that bucket, you need to have the discipline to not dip into another bucket or a credit facility like a credit card to top you up. You need to turn around and say, okay, it's Friday. We've spent all of our discretionary income. We don't have anything left until, say, Monday. We're actually having a quiet weekend this weekend because we don't have any money. So we're going to just Netflix and stay at home.
Yeah, it takes a bit of discipline, but the key in any plan, and it doesn't matter who you're talking to, doesn't matter, what client we're speaking to, the key in any financial plan is the cash flow. If there's no cash flow, if there's no surplus income, if you're not managing that effectively, then everything else falls apart. Doesn't matter how good the investment strategy is, doesn't matter how good all of the other stuff that you're doing is. If you fall over at the cash flow hurdle, then everything else falls apart. Likewise, if it's done correctly, so when it's managed correctly, that's the most powerful thing when it comes to any wealth creation strategy, any financial plan, is making sure that there's focus, there's attention, and there's a good handle around the income, the expenses, and all of the stuff that's coming in and out of the household. So is most certainly, you're not meant to have a favorite, but that's most certainly the real important and key feature in any financial plan.
No, well said. Next one, debts. Getting our debts under control.
Exactly right. I mean, you want to recognize good debts versus bad debts. Your investment debts, the ones that are tax deductible, that are used for wealth creation purposes. Not that you never want to pay them off, but they're the ones that ideally you'd like to, pay down later. If there's, overhanging credit cards, personal loans, those, really bad debts that are lingering over you, then you certainly want to make sure that you're tackling all of that stuff before you're looking at investing and doing any of that stuff, because that's going to have a far greater impact. But yeah, if there's any debts, making sure that that's under control once you've got a good idea of, cash flow position, income, expenditure, how much you can throw towards it on a, weekly basis. That's ultimately going to be the next point in call is really tackling those debts, getting that under control. And, included within that is maximizing debts as well. Equity in properties, ability to borrow, ability to further expand and leverage your wealth is definitely something that can also form part of the plan. So determining your debt strategy is not just looking at pay it off, but also looking at making sure that it's in the right position, making sure that it's managed effectively.
Yeah, and one of the things that really springs to mind with this, and it's been an interesting time of late, I mean, obviously interest rates are going up, but the one that jumps to mind for me is mortgage rate. And you're right, I mean, no matter what you do, unless you're really lucky and really fortunate, you can't wave a magic wand, make your mortgage disappear. But one of the things that you could do as part of this process is review the interest rate. So if your lender has, moved, like I guess all of them have recently, it's a good opportunity to look at your interest rate and say, hey, is it competitive with other options in the market? And if it's not, then, you look at it, are you in a position to refinance? That could then not only give you a more competitive interest rate over the longer term, it's going to save you the amount of interest that you pay back, but from a cash flow perspective as well too, it should make your cash flow a little bit easier as well. And that could then give you the opportunity that if you do have some of the other debt, like consumer debts and credit cards, if you have freed up some surplus, because you've got a better mortgage interest rate, then maybe you can divert that to your personal debt or your credit card debt to help pay that back faster. So there's a couple of things working in combination here that can help get your debts under control as well. And probably the only other one that I was thinking about, Andrew, is, and this is a little bit more complex and a little bit more technical, and you need to be careful with it. So proceed with caution, but debt consolidation. So if you do have multiple debts across the board with different providers and different lenders, and you're struggling to make repayments because you're making a repayment to, this person today and that person tomorrow, and you just can't keep track of it, one of the things that you can consider is rolling all of those debts into one. So it's one debt and it does become one repayment. Once again, there's a whole heap of pros and cons associated with that, a little bit more technical, so you need to proceed with caution, but that could also make the management of it a hell of a lot easier. Plus, if you do it effectively, you might be able to get better terms in terms of interest rate and lower your overall repayment.
Yeah, absolutely. Absolutely. So yeah, a little bit in that one, but certainly a whole heap of, value that you can add into your cash flow, surplus income, and what you can do moving forward as well if you really get those debts under control.
Next one, Andrew, developing an investment strategy.
This is the exciting stuff, yeah. I mean, look, truth be told, I dare say 99% of clients that come into the business, they're already at this stage, or they think that they're at this stage. And so it can sometimes be a difficult process when someone comes in and sees a financial advisor. Usually the instigator or the thing that's brought them in is they've got an amount of money, or they want to, put away an amount of money so that they can start investing. But I will reiterate that this is definitely a step that only works if all of the other things are taken care of. So you really need to make sure that this is your fourth step or your fifth step in your overall, financial plan. So a lot of the times people will come in and say, yep, I want to invest, but then you look at their surplus income and they're going negative. And even though they've got a large cash balance because they've liquidated an asset or whatnot, you need to solve for the budget. You need to solve for the income versus expenditure. You need to solve for all of the other things before you start tackling, okay, what's the wealth creation plan? So making sure that everything else is in place before you actually embark on an investment strategy is really important. But once you've got that under control, the investment strategy, as you said, that's the exciting part.
Yeah, you mentioned it before, Andrew, that, that's a lot of the reason why clients come to us. They think that they're in that position. And as you were describing that, I was thinking about, as another profession trying to explain this concept, but it's like going to a PT and saying, I want to get fitter, or I want to put on some size, or, I want to bulk up my muscles, or whatever it may be. And then they start talking to you about things like, are you getting enough sleep? Are you drinking enough water? What's your diet look like? And that's kind of the process that we go through as well too. Yeah, we talk to clients about investments, but you need to get the other stuff. In order for it to be effective, you can still do it, but in order to be effective and maximize it, you've got to get the other stuff sorted out right first. But yeah, that's the exciting piece. And coming back to the gym analogy, that, yeah, obviously getting the body that you want or the results that you want is the exciting piece, but talking about how much water you drink and how much sleep you get, not as exciting, but absolutely critical. And yeah. So there you go. We're the PTs of the financial planning world. How about that? How about that for a slogan? We'll put that one out to our listeners and see what they say.
But yeah, I mean, look, the investment strategy is ultimately, it's the most exciting because it's something that you're looking forward towards. So what you really want to do is establish a goal, what am I actually aiming towards? What am I trying to get out of it? Because it's really easy to say, yep, this is a great asset class, let's invest in this. And all you're doing is jumping from one asset to another asset to another asset and constantly running that rat wheel. So what you want to be doing is looking at, all right, what are my short-term wealth creation goals? What are my longer-term, lifestyle and retirement income goals? How am I going to formulate a strategy on actually how to get there, as opposed to just let's acquire an asset, and we're not actually doing it with any purpose. And what ultimately that leads to is you acquire assets, and then you decide to, all right, now's the time that I'm going to stop, now's the time that I'm going to retire. And you realize, probably haven't done this as effectively as I wanted to. I'm wanting to draw down on a portion of my assets. However, all of my assets are invested in property and I have to liquidate a property in order to be able to do it, as opposed to, holding a combination of liquid assets that I could have taken a larger income drawdown over time, or I could have, liquidated only a portion of the assets as opposed to paying for full capital gains. I mean, there's a million different things and ways that you can structure this, but ultimately having the end goal in mind is going to mean that you're more likely to be acquiring assets that are better positioned for your wealth creation goals and for what you're trying to achieve in your strategy. But yeah, absolutely. Investment strategy is the exciting part. That's what we're doing day in, day out. That's what we're excited about as well. But yeah, definitely a whole heap in this one. And we could probably talk for, I dare say our almost entire podcast is based on this topic alone. So yeah.
And then we pivot into risk mitigation, which is kind of like the plan B in case the proverbial hits the fan, right? So not necessarily the most exciting part of the process, but from our perspective, we manage risk as part of our process. And one of the things that we talk to clients about is making sure that their risk mitigation strategies are in place, that if something does go wrong and does go pear-shaped, then it's not going to derail the financial strategy, the financial plan that we've got. It's not going to disadvantage the person or the family that we're doing the advice for. Basically, we use a couple of things to do it. If a client is in a position to self-insure, they've got enough assets that the risk mitigation strategy is taken care of. We assess that, and if that's the case, fantastic. If not, one of the easy ways is deferring and transferring that risk across to an insurer by taking out insurances.
Yeah. So, and look, risk mitigation is also encompassed in the investment strategy as well. So making sure that you're diversified across your investments, making sure that if it's appropriate, whether you should be holding your investments in trusts or whatnot, whether you should be taking out buy-sell insurances if you're self-employed, like the investment part of this aspect. This can stretch really far and wide. And for some people, it's quite simple. As you said, you self-insure and you've got sufficient assets to be able to do that, which is absolutely fantastic. And all that you're looking at is the risk mitigation of the investments and the strategy itself. But for other people, it's a little bit more complex. It requires a little bit more time. It requires a little bit more attention, but it's ultimately dependent on your circumstances and what you're aiming towards as well.
Yep. Well said, Andrew. And lucky last, estate planning piece.
Really often overlooked. Something that, I don't know, people don't like thinking about. I don't think anyone likes thinking about it, to be honest with you, but it's just one of those things. You got to do it. Yeah, exactly.
You've got to be mature about it, and hopefully if you do it right, you can do it and not have to think about it for another couple of years after that. So
yeah, but estate planning is really important. It's really relevant in every financial plan, because if you're embarking on a financial strategy, if you're embarking on wealth creation, then ultimately it means that you're trying to accumulate assets. And if you're accumulating assets, then you want to make sure that those assets are being passed on in A, the most tax efficient manner, but B, to the people that you actually want it to be passed on to, and you want to make sure of that. Incorporated within that is obviously, engaging with other professionals, engaging with your estate planning lawyers, engaging with your accountants, making sure that everyone is all on board and everyone is all, essentially enacting what you would like to see if you're no longer around, or if, you don't have the capacity to make decisions and whatnot. But yeah, the estate planning piece is another massive one in all of this.
Yep. And the one that I always tend to think about, and that's just because of the position that I'm in, is in the event of, something happened to both parents in terms of our children. So organising not just what happens with us, with our assets when we're no longer here, or if we're unable to make decisions on our own, all of that sort of stuff. But it goes a little bit further. In the event that both parents, who then looks after our children, what does that look like? How is it funded? Is there certain wishes that we have around education, upbringing, values, religion, you name it? So when you extend that a little bit further and it's no longer about you and your mortality, I think it's a bit of an easier piece to lean into, because you are then doing it for, if you're in a position where you've got children, especially if they're minors, it tends to make it a positive experience rather than a negative one, thinking about your own mortality. But if you've definitely got young children, I think it's one of those things that's at the top of the list.
Yeah. And hopefully you do it once, you do it a couple of times, or you only need to review it every so often. You don't need to be looking at it all the time. But yeah, you do it once, you do it right. It means that it's not in the forefront for at least a couple of years.
Yeah, you need to get it reviewed. But if your circumstances change, that's the trigger for it, or, depending on what happens with the laws and stuff. But always good to get it reviewed. But you're right, absolutely. Do it once, do it right, and then you've got the baseline for it, and it should be a lot easier and a lot smoother from that perspective onward. So yeah.
Beautiful. Well, Bills, we've come to the end of the 50th episode of the 360 Money Matters podcast. So thank you. As always, great to jump on another podcast with you. To our listeners, thanks again for listening out. Our details are in the show notes if you wanted to discuss any of this, or if you do have any other questions, we'd be more than happy to hear from you.
And Andrew, thank you. 50 episodes in. Feels like we just started yesterday. And to our listeners who have been on the journey with us from the start, I really appreciate your attention and listening to our podcast, and we'll continue to do our podcasts and hopefully deliver more and more value. and give you an insight into the financial planning world and what we do and what we think about. And we'll catch you on the next one.
Thank you.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.